Hi everyone, thanks for joining me for this edition of First Bank's Wealth Management Market Commentary video series. I'm Bill Dolan, Senior Portfolio Manager with First Bank's Wealth Management Group. Today I want to talk about alternative investments. First I want to say that in our industry we define alternative investments as any investment asset other than stocks, bonds, or cash. So obviously this is a pretty broad category and sometimes it can mean different things to different people. Let's take real estate for example. Since real estate is not stocks, bonds, or cash, it's classified as an alternative investment in the wealth management industry. But to many people, real estate is even more familiar than stocks or bonds and therefore seems every bit as traditional. Nevertheless, for purposes of our discussion, we'll stick with the framework of stocks, bonds, cash, and everything else alternatives. Okay, besides real estate, some other examples of investments that fall into the alternative investment category are private equity, hedge funds, precious metals, commodities, private debt, and others. And with the recent turbulence that we're seeing in the stock and bond markets, I wanted to highlight the role alternative investments can play in a portfolio that includes stocks and bonds, and that is to generate strong returns and to diversify risk, to lower risk in the portfolio. This can be accomplished by including investments that don't share the same risks as the other investments in the portfolio. Investments have risk. That's why, as investors, we get a return or compensation for taking on risk. Risk comes in many different forms, but like the ancient Chinese merchants who didn't put all of their goods on one ship when trading and instead spread out their wares onto multiple ships to protect against loss if a ship went down or if it was attacked by pirates, diversifying. Investors today are well served by spreading their risks amongst various investments. And this is the part that may not be intuitive, but adding a risky investment to a portfolio can actually lower the overall risk of the portfolio if its risks are different than those of the other investments, while at the same time offering the potential for higher returns. This is the appeal of alternative investments, and it works if you can identify and gain access to investments whose risks are truly different and not shared with the other investments in the portfolio. Think about stocks and corporate bonds, where traditionally advisors would balance portfolios using these investments thinking they were diversified. But as we saw during the financial crisis of 2008 and 2009, this diversification didn't hold up, and that's because publicly traded corporate stocks and corporate bonds share many of the same risks. And the values of these investments went down together. But if you had an allocation to or a portion of your portfolio in investments that had different risks, like currency exchange rates or reinsurance that's linked to natural events or investments that make money when markets decline, you are likely to fare better and buffer the severe losses experienced by many investors during this time. And by reducing the volatility and lessening the level of losses, your portfolio had less ground to make up and your wealth grew more. For these reasons, along with where we're at with the current interest rate environment and equity valuation levels, an allocation to alternative investments is becoming increasingly important in the pursuit of investment objectives and effective management of risk. And with that, I want to thank you for watching. And if you have any feedback or questions for me, I'd love to hear from you. You can reach me at bill.dolan@fbol.com. Thank you.